Welcome back to the Deep Dive. Today we are really cracking open a critical piece of performance management. It comes from this visual overview, chapter 14, basically, and a high-level framework about how organizations measure success. And look, this isn't just bean counting or accounting principles. It gets right into the psychology of control, setting targets, and even, manipulation.
That's absolutely right. And that's why this source material is so fascinating. It shows how these, quite sophisticated financial metrics collide head on with actual human behavior. It's a very structured blueprint we're looking at. And for you, the listener, we've really got three key things we need to pull out of this deep dive.
Okay, let's unpack that. What's the kind of core mission here based on this material?
Right. The mission is threefold, really. First, we need to clearly lay out why standards and budgets can't just sit there, why they have to be revised. Second, we need to get a handle on the, frankly, complex calculations involved when you do revise them. And third, maybe the most interesting bit we have to explain the effect, the real impact that using variance analysis has on how managers and employees actually behave.
Yeah, the moment you set a target, the whole dynamic changes, doesn't it? So let's start right at the beginning, where the source puts it. Revision of budgets and standards. It seems to argue that, fundamentally, good management accounting means standards have to be alive, dynamic things, not just, static relics from last quarter.
Exactly. I mean, think about it. If the world changes, input prices shoot up, there's a shipping crisis, whatever, and it always does change, right? Then your budget has to change too. Holding a manager to an old standard when their costs have fundamentally shifted, that's just unfair. It kills motivation. So revision isn't just like good housekeeping. It's essential, a necessity.
Okay, but revising isn't simple. Which brings us to the tools designed for that complexity, planning and operational variances, or P&O variances. The source suggests these exist because, well, traditional variance analysis often just can't cope anymore.
Right. And what's really interesting is why traditional analysis fails. It's often because it can't properly separate let's call it luck from skill, or external factors from internal performance. It tends to just blend these two very different things together. Things a manager couldn't possibly control, market shifts, get mixed up with things they can control, like how efficiently their team works.
So if, say, the price of copper skyrockets because of some global event, the old way might penalize the production manager for high material costs. Even if they ran a line perfectly, you're hitting them for a supply chain shock and maybe their own team's efficiency in the same number.
Precisely. That's the problem P&O variances were designed to solve. This analysis tries to distill accountability. It separates the change in the plan caused by external stuff, that's your planning variance, from how well you executed against that new, revised, fairer standard. That's the operational variance. Getting that separation right is, well, it's fundamental for modern performance management.
And to get that separation, you really need to dig into the technical details. The source lists some key components we can't just gloss over. They define the scope, right? What are they?
Yeah, we're talking about the building blocks for making this realistic. First up, planning cost variances. These are vital. They basically capture the necessary adjustments to the original standards to reflect what costs actually are now. You adjust for the cost change first, so the operations team isn't measured against, pure fantasy.
And that realism has to apply inside the business too, right? Like labor efficiency.
Absolutely. Which brings us to the tricky relationship between the learning curve and labor when you're setting standards. This is a big one. Think about launching a new product, the first few batches. Slow, costly. But then the team gets the hang of it. They get way faster. That's the learning curve.
So if you set the labor standard based on that initial slow start and then judge the team against that same standard 6 months later when they're experts, it's just broken, isn't it?
Totally broken. If you ignore the learning curve, you set an impossible standard early on, which is demotivating. And later, you set a standard that's way too easy, which doesn't push for real improvement. You have to keep adjusting those labor standards downwards as people learn and get more efficient. It has to reflect reality.
Makes total sense for internal stuff. But performance isn't just internal. The source says you also need to look outside, at the market, especially for sales.
Yes, exactly. The technical side demands analyzing two key external market factors, market volume variance and market share variance. Because you can't just look at someone's total sales revenue variance and say good job or bad job. You need the context. What was the whole market doing?
Walk us through that difference. Because this seems like where the precision of P&O really makes a difference.
So market volume variance basically asks, did the whole pie get bigger or smaller? If the entire market for, say, widgets tanks by 15% because of a recession, well, your company's widget sales are probably going to drop too. That's largely out of your sales team's control. That drop related to the overall market shrinking. That's treated as a planning variance. It's market conditions, maybe bad luck.
Okay, but then your actual performance isn't just the total drop. It's how you did within that shrinking pie.
That's it. That's the market share variance. This measures your operational effectiveness against competitors. Did you gain ground or lose ground relative to everyone else? So if the market shrank 15%, but your sales only dropped 10%, hey, that's actually a win. You grabbed a bigger slice even if the whole pie was smaller. P&O makes sure the sales manager gets credit for that operational success, for gaining share.
Okay, that clarity, that fairness, that's the obvious advantage. But the source material also flags disadvantages of using P&O.
Yeah.
What's the catch with all this detailed analysis?
Well, the most obvious one is it's more complicated, it takes more effort, more data, sophisticated models maybe, it costs more to run this kind of system. But maybe more importantly, it turns performance management into a bit of an intricate numbers game. When you add all this detail, you create more dials to tune, more levers for managers to potentially pull.
And that sounds like the bridge to the behavioral side. This system, designed for fairness, could actually open the door to manipulation.
Yeah.
How does that work? How does the technical detail enable gaming the system?
Yeah, manipulation often creeps in when managers understand and maybe exploit that clear line between planning variances, the uncontrollable ones, and operational variances, the controllable ones they're judged on. So imagine a manager negotiating next year's budget. They might push for a really conservative standard, maybe inflate expected costs, or lowball the sales target knowing they can probably blame external factors later.
Ah, so they build slack into the plan itself.
Exactly. They might argue the market shift was bigger than it really was, inflating the adverse planning variance. Why? Because it makes their operational variance, the bit that maybe drives their bonus, look artificially good by comparison. So the tool designed for clarity. In the wrong hands or with the wrong incentives, it can become a pretty sophisticated way to muddy the waters, all to maximize personal gain rather than organizational performance.
Well, okay, that leads us perfectly into the human equation, doesn't it? The behavioral aspects of standard setting. If the technical side has this shadow of manipulation, the human side is all about how people react, what motivates them.
Right. This is the so what for every single employee who's measured by these standards. We have to look really closely at how these complex standards and the variance reports actually influence staff motivation and action. Are they seen as fair challenges? Or are they just demotivating punishments? If people feel the standards are impossible, or if they think the manager can just play with the numbers anyway, well, they tend to disengage. Why bother?
Yeah, if the bar feels impossibly high, you're not even going to try and jump, are you?
Precisely. The sweet spot is standards that stretch people, that push the organization forward, but are still seen as attainable. Because we know the moment a standard is set, it's directly tied to performance and performance evaluation. Standards become the basis for judging success, which means they're tied to pay, promotions, everything. And that drives very specific actions, very specific behaviors.
So if a manager knows their bonus hinges entirely on minimizing, say, adverse operational cost variances, they'll laser focus on that number, even if it means, I don't know, cutting corners somewhere else that isn't measured, like sacrificing long-term quality for short-term cost wins.
That's the classic tunnel vision effect. And to fight that, the standards themselves have to stay relevant. They need relevance and context. Our sources specifically mention linking standard setting to modern ways of working like JIT, just-in-time, and TQM, total quality management. JIT aiming to slash inventory, TQM focusing on quality everywhere. Why is that link so important?
Well, if a company adopts JIT, the goal is practically zero inventory, right?
Right. So imagine your variant system still gives managers a pat on the back for having big buffer stocks, maybe a favorable inventory variance. That system is actively rewarding behavior that contradicts the JIT strategy you just invested millions in. Standard setting can't live in its own little bubble. It has to align with how the business actually wants to operate today, or the evaluation process will literally pull you in the wrong direction.
So it's a constant need to keep the standards relevant, to check them against yesterday's assumptions. And ultimately, when these standards, whether they're perfectly calculated or cleverly gamed, are put in place and monitored with variance reports, you see certain behavioral patterns emerge from employees. What should managers expect to see?
They should expect human nature, really. Predictable responses to pressure and incentives. We see that tendency towards building in budgetary slack during planning. We see the potential for outright manipulation we talked about. And very commonly, if standards feel impossible or just irrelevant to the real job, you see apathy. You see minimal compliance doing just enough. You see effort focused only on the metrics being tracked while other important things get ignored. Management has to think about these likely behavioral patterns when they design the system, not just when they're crunching the numbers afterwards. The numbers might be predictable, but the people reacting to them, less so.
Okay, that really brings us nicely to wrapping this up, synthesizing this deep dive. We started with that foundational need for budget revision, those core principles. Then we went into the weeds on the technical tools, P&O variances, looking at everything from the learning curve for labor to market share dynamics. But ultimately, we landed squarely on the messy, complex, unpredictable human side, the behavioral aspects.
Yeah, and if we try to connect all those dots, look, calculating market volume and market share variances gives you incredible financial insight. It's rigorous. But that very financial power, that ability to separate planning from operations, also creates the risk of manipulation. If managers choose to exploit that distinction between luck and skill, they can use those precise technical tools to basically manage the perception of their performance, playing on those predictable behavioral patterns within the system.
So what does this all mean for you listening, whether you're the manager setting standards or the employee being measured by them?
Well, being able to accurately calculate planning and operational variances, that's critical for modern management accounting. It offers a precision traditional methods just lack. You now understand why separating uncontrollable market shifts from controllable internal efficiency is so key for fairness. But here's the thing. The real challenge for any organization isn't just getting the numbers right. You can hire smart analysts for that. The true ongoing challenge is managing the unpredictable effects on staff motivation, the strategic and sometimes counter-strategic actions people take because of how they're evaluated, that tension between the cold, hard objective metrics and the messy human reality driven by incentives and self-interest. That's the core conflict you really need to grapple with in your own context.